Mortgage rates just broke above another key level, and the reason is becoming all too familiar. Bond markets are under renewed pressure this morning as investors continue to grapple with the economic impact of ongoing Middle East tensions. The biggest concern remains the same: energy prices. Gasoline prices have climbed again to multi year highs. And that's reviving concerns that inflation could stay elevated longer than previously expected. As a result, bond yields moved higher overnight. Selling continued after U.S. markets opened, and mortgage rates are facing additional upward pressure. Several familiar themes are working in the same direction. Higher oil and fuel prices are fueling inflation concerns. Investors are reducing expectations for near term rate cuts. And bond markets have broken through several important technical support levels, encouraging additional selling. There was also an announcement from the European Central Bank where officials acknowledged that additional rate hikes could still be possible later this year if inflation remains persistent. However, U.S. Treasury bonds are actually performing worse than European bonds today, suggesting the ECB isn't the primary driver of today's sell-off. One particular market is sending the clearest message. If there's one place to look for the market expectations, it's the 2-year Treasury yield. Because it closely reflects expectations of future Fed Reserve policy, the 2-year Treasury has steadily climbed since March as investors have gradually accepted that interest rates may stay higher for longer. Today's move is simply another chapter in that story. Why this matters for mortgage rates. Mortgage rates continue to face headwinds from persistent inflation concerns, higher fuel prices, reduced expectations for Fed rate cuts, and technical selling in the bond market. The result is a more challenging environment for borrowers than we saw just a few weeks ago. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.